And with CBA's results, Julia, coming in pretty much in line with what the market had expected, about $7.11 billion cash profit. Your thoughts on it?
I think the CBA result was a good one. It was always going to be difficult for Commonwealth Bank to beat expectations given the very tough fourth quarter trading environment. And yet despite this, we have seen it coming in ahead of consensus and ahead of our expectations as well. We were expecting to see a cash profit of $7.084 billion and the consensus of the market stood at $7.093 billion and the actual results come in at $7.11 billion. So all up, that cash profit better than expected. The dividend also coming in ahead of expectations. We were expecting to see $1.93. It's coming at $1.97. I guess the disappointing part of it is the net interest margin. We knew there would be net interest margin pressures, but we were expecting to see it come in at 2.14%, but it's actually coming at 2.09%. Remember, NAB in its third quarter trading update yesterday didn't disclose the net interest margin, which it usually does in its quarterly update. So it does look like the bank's still facing pressures in terms of that net interest margin, and I guess that's been reflected by CBA's move in terms of cutting interest rates. In May, we didn't see the full 50 basis points passed on, only 40 basis points being passed on, and in June we only saw 21 basis points being passed on. So reflective of the environment that we are still seeing net interest margin pressures, but all up it does look like growth is decelerating for the banks, but they are still growing, and it's great to see CBA coming in with a record profit ahead of expectations given that very tough fourth quarter trading environment.
Westfield Group. So, Julia, let's get your take on those ones. Obviously, the share's not quite online just yet. Take us through those numbers.
Expectations, we were expecting to see $754 million. They actually came in at $800 million. So a very strong result coming through from Westfield, and that distribution in line with our expectations. Now, the passive investment side makes up about 80% of pre-tax income. So if we have a look at their passive investments, well, we did see Australia growing by about 2.5%. The US was a standout. We were expecting to see a little bit of a weaker result, but we actually saw growth of 3.3%. So that was ahead of our expectations for 2.3%. But of course, if we have a look at some of the catalysts for Westfield, there are a number of catalysts coming up, and it does look like an exciting time. And the first of those is just renegotiating that joint venture with AMP. Some of the most attractive shopping centres are in WA, so it'll be interesting to see whether Westfield picks up a couple of those, as well as Ringamore in New South Wales. And then, of course, we know that Westfield has had about $4.8 billion worth of asset sales, so not surprising to see an acceleration of its developmental pipeline and its growth opportunities there. But I think a real catalyst for Westfield is going to come in FY13, where we will start to see some renegotiation of Westfield London rents, and we have seen quite strong UK sales there, so we should see an uplift in terms of rent, and that could be a positive going forward. But for today, Westfield's result coming in ahead of our expectations.
Julia, they're going to need to get some pretty good rent, I suppose, revisions, if you like, to make up for the absence of any massive asset sales and investments, which has really helped buffer this bottom line, I would have thought.
If we have a look at Westfield, around about 80% of its pre-tax income does come from its passive portfolio. So that's the income part of its portfolio. And I guess having a look and breaking that down, the US does form a smaller portion of that, about 40% of its portfolio. So it has come down significantly. But those growth opportunities are going to be what drives the capital growth opportunities in terms of this stock. So we're going to be watching that one closely. So traditionally, very much an income model, but going forward, they are going to be focusing on their developmental pipeline, and that's really going to be a key driver of the share price.
And when you switch over to Oz Minerals, the dividend there, that looked like it really missed the mark. I saw estimates of 15 cents for Oz Minerals dividend, and I think it came in at 10 cents. But also you've got the cost problems there. Tell us what's going on and how concerning that cost number looks to you in the results today, because the shares, I could just see them come online, they're down 3.7%.
And this was always going to be the strange one. We knew that CBA beat market expectations, Westfield beat expectations, and would probably see a strong share price performance from both of these stocks on the market today. But Oz Minerals was always the one that we weren't quite sure how it was going to react today, because we've seen the result actually coming in ahead of expectations, and yet the dividend coming in quite significantly below expectations. So we were expecting to see a profit result of $105 million. They've actually come in at $119 million. and that's despite the cost pressures during the half year, as well as the prices of their key commodities, gold and copper, being below 2011. In fact, copper prices down 11% compared to 2011, and yet the dividend's a significant one because we know that people in the market have been calling for these resource companies to increase their dividend, and yet we've seen a cut in dividend coming through from Oz Minerals. As you mentioned, Brooke, cost pressures, we are expecting to see costs for 2012 now be at 110 to 120 US a pound. That's up from their previous forecast of $1 to $1.10 per pound. So it does look like significant cost pressures are in play there, as well as the lower realised prices. So it does look like, given that weaker outlook in terms of cost pressures and in terms of realised prices, the market is punishing Oz Minerals today, despite that profit result for the half year coming in ahead of expectations.
Julia, how difficult a situation is it, particularly for the bigger miners? Look, we know there are cost pressures at the moment right across the different sort of commodity classes, but we do know as well that a lot of these guys are sitting on a mountain of cash. Oz Minerals, for one, has a lot of cash in the bank, needless to also speak of Rio and BHP as well. And yet their share prices lag so much. Many people suggest because of their poor dividend, their poor cash out, payout, if you like, to investors. Do you think, like we saw with Rio, that it's starting to get to them, that the bit of public pressure, particularly from those insto shareholders, is coming to bear, and we'll see BHP, for example, come out with a high dividend?
We've certainly seen that from some of the miners, but it does look like we've seen Oz Minerals really err on the side of caution, given the global growth environment and some of the caution regarding growth, given the softer conditions and the numbers coming out of China, as well as what's happening in terms of Europe. So it does look like that cut in the dividend, just more of a cautious approach, because, James, as you mentioned, Oz Minerals has a lot of cash. It's got cash of about $450 million, so a lot of cash on its books that it can potentially spend for acquisitions. But of course, there's three things that are impacting on the miners at the moment. First of all, are the lower commodity prices, and that's just a reflection of global growth concerns in the marketplace. Secondly, it's not only miners in Australia, but we are seeing cost pressures from miners all around the globe. So at a time when commodity prices are falling, we're actually seeing costs rising for the miners. And thirdly, usually when we do see commodity price weakness, what we see is a weaker Australian dollar. But unfortunately, we have seen strength in the Aussie dollar, and so that's a double whammy for a lot of the miners, because usually the weakness in commodity prices is offset by a weakness in the Aussie dollar, and because we're not seeing that, of course, it makes it a more difficult environment for those miners, which are key exporters, and that high Aussie dollar is certainly not good news for exporters.